at some point sorry about that. At some point, someone on our team will be able to share a link to where you can register to participate. So if you want to fundraise and pledge to run a certain number of miles or walk a certain number of miles. Last year, we had people who danced for 20 minutes. We had people who rode. We had people doing different things. I think it's really more about just committing to doing something that you love. You can bring in your community. I'm doing it with my family. Some people are doing it with people who are in the classes, for those who are USAPAs. But at the end of the day, it's for a good cause, right? Supporting education in Zimbabwe for our fellow youngins who are in Zim. So look out for the details there. There's a link in the chat right now where you can register and log in. And if you have any questions, please feel free to reach out to myself or anybody on our team. So before we get into today's session, I think, we've always said that we are grateful to Education Matters for having us host these sessions. They are about education. It is part of our vision as Education Matters. And the views that anything we discuss here are views of the panelists. Today, we're talking about investing, and it could be a very tricky conversation. So I do want to put it out there that, we're not offering investment advice. Our panelists will use examples to clarify points, but it's not investment advice. At the end of the day, you need to go home, do your own due diligence, do your own learning, figure out what your strategy is, and make your investments. So without further ado, I am really, really excited that we have Tap Tapfuma Chibaya and Brian Tafazo Marumbedzat with me today, who we're going to be having this conversation with. And I think it's because it's such a broad topic, right? I do want to frame it for us a little bit so that you have a sense of how this conversation is going to go. So we're going to start with the what, the why, and when of investing. We'll go into the how you can invest. From that, we'll cover how you can manage your investments over time, and then close with any additional Q&A that we would not have covered, and then wrapping up. So we should be on here for at least about another hour, which I think is hopefully some good time to cover this very broad topic, but we'll try to make it as insightful as possible. So with that, I want my two panelists, Tapiwa and Brian. I'm not going to introduce yourselves. I think it's better if you guys introduce yourselves. I am very excited to have you both here today. So Brian, let's start with you. Calling in from Harare today, can you please introduce yourself to the guests? Welcome, Brian.
Thank you, Ru. You can hear me, right?
Yes, we can hear you.
Thank you so much. This connectivity that I have is sponsored by Econet Wireless, so I thank them for that. I was on Zoho Wi-Fi before, and Zoho Wi-Fi did not perform. So apparently Econet, the data is actually doing well, which is amazing. But anyway, I'll preface this also by saying that I'm a shareholder of Econet Wireless, so I'm not doing a bidding for them, but I think they're a good company. But now to me, I'm just a USAP student who was born and grew up in Nyanga in the eastern side, which I still consider to be one of the best districts and one of the most important districts in the country. I went to UC Berkeley. After I was a USAP student, I went to UC Berkeley and I studied political economy. And then I went to Wall Street, which is where most kids go in the US when they want to realize big dreams. And there I worked for a German bank, which is called Deutsche Bank, where I worked for a private credit team that invested in technology companies. And then talking of investing, which is the topic we have for today, I started investing actually when I was fortunate enough to work at the Mutare American Corner. I took a gap year between my Form 6 and going to university in the US. And so when I started getting my small salary there, which was, I shouldn't call it small, it was really interesting. It was a good salary, especially if my Mano is here, who was responsible for determining my salary. So it was a good salary. And I did actually commit to investing part of it in the stock market in Zimbabwe. So that's when I started investing. And then after that, I did move to the US, where I also started investing there. And then after some time in the US, after about 4 years in the US, that's when I looked back to the continent and I started investing in other markets on the African continent. So I have investments now in 9 different African countries, and I guess we'll talk about that. But that's sort of my investment journey. And then the last thing being that starting last year, I started to talk about investing in Africa on a YouTube channel that I have, but that's also something that we can cover later. Thanks, Ru.
What's the name of the YouTube channel? Let's just put it out there right now before we move on.
Okay. The name of the YouTube channel is called Maro of Africa, which is the first 4 letters of my last name, Maro Mbedza, M-A-R-O of Africa. And I thought it was the easiest thing to tell people so that they would remember, but it turns out it's not that easy. But Maro of Africa is the name.
Got it. Okay.
Yeah.
Thank you. Welcome, Brian. Thanks for that introduction. And Mr. Tack.
Great, thanks.
Calling in from Washington, DC today, right?
That's correct. So falling in from Bethesda, Maryland, to be precise. Thanks for giving me the honor here to speak to this esteemed group of individuals. I think I absolutely align with and applaud everything that you guys represent. It's an absolute pleasure to be talking to you guys. So I'm Yusuf, class of 05 and 06. 05 and 06 because initially I was 05 and I didn't make it on my first try to come to the US. So I ended up going to NUST in Bulawayo. I see a couple familiar names here in the panel. So I did about 6 months there before, my minor convinced me to reapply, which was a terrific idea. So I did reapply and ended up in Middlebury, Vermont for my undergraduate, where I did economics and mathematics. So, similar to Brian's story of coming out of college and, trying to, to get the American dream, I also ended up on Wall Street in 2011. So I started off at Credit Suisse doing equity research, and that was really my first foray into finance and investing. And at that point, I started playing around with a little bit of my money, putting money into the stock market. So I started pretty early on. We'll talk about this a little bit more. I wish there were a couple of things that I had done a little bit more and a little bit smarter back then. But ever since I've been investing in the stock market. So I spent 3 years at Credit Suisse. Decided I wanted to try something different. Went to JP Morgan for 2 years, did investment banking. Didn't love the lifestyle. I don't know how Ru manages there. So I left investment banking at JP Morgan, then came over to a very small privately owned high net worth asset manager in Bethesda, where I am, a portfolio manager as well as an equity analyst. So I kind of straddle 2 roles there, where I'm on the idea generation side as well as the asset allocation side. So in a nutshell, that's my story. Happy to go into more detail as we go along with the session. Yeah.
Tap, I'm gonna go real deep into you.
Sure.
You are a recent father, is that correct?
That's
are we
correct.
Celebrating?
That's correct.
Yes. So you live in Bethesda with who?
So I live in Bethesda.
I told you we go real deep in these because it also helps to give context, right? Because you also now talking as a father.
Yeah.
And I think, sometimes it also makes a difference because your goals, I'm sure will be.
Absolutely. Yeah.
Yeah.
Absolutely. So I live in Bethesda with my wife and my kid. My kid is not that young anymore, but he's going on 2.5 months. 2 years and 6 months. Very active boy. Taz is his name. Keeps us very, very busy, but an absolute joy. So that also brings a certain level of renewed responsibility as you just think about building wealth for posterity. Keeps things into focus and really refines your goals, and as you start thinking about what I need to leave behind for Tazi and Tazi's kids and Tazi's grandkids, etc.
Thank you. Okay, so the topic, right, is it's investing in the stock market. It is one of the key topics around, you know, creation of generational wealth, the growing of generational wealth. And I think maybe Tab, let me start with you with this one. Can you just differentiate for us, because we need to set this right from the beginning, the difference between investing and trading? Because today we're talking about investing, and I think we just need to make that very clear from the beginning.
Yeah, absolutely. That's a great question, and that's one of the things that you kind of differentiate as you think about what you're trying to do with your money here, right? Completely different skill sets that you need to do both. So, trading, the way I think about trading is very short-term oriented, right? And investing, you're really thinking more along the lines of, a term horizon, a long-term horizon. With trading, it's it's a lot more fast money driven, and you're probably going to be thinking about moving volumes on the pennies. So you're picking up pennies essentially, but you're making money on the volumes, right? That's how I like to think about trading. So, with trading, you come with a very short-term time horizon. You also got to think about the costs that you incur, because you're blowing in and out of positions pretty rapidly, right? And a lot of the times you're probably gonna end up looking at charts, right? You think about execution levels of stepping in and stepping out of the market, right? With investing, and the other thing that I'd say with trading, it almost has to be like a full-time occupation, right? That's, you're really just looking at the screens pretty much on a daily basis. With investing, you can take a little bit more of a, set it, unlock it, and don't look at it approach. And that's not to say don't even bother looking at your investment.
Sorry about that.
No worries. So with investing, you really need to think about, a much more longer term time horizon, where you have, certain goals and objectives that you are trying to achieve, and you can always come back at periodic intervals and rebalance your allocations. If your objectives change, you can rebalance to try and reflect the new objective. So, the biggest difference is really time horizon. Trading is more short term, you're moving in and out of the market. Investing is more, I'm gonna take, the long-term view here, and possibly be a little bit patient with my capital, and I'm gonna do quite a fair amount of diligence and homework before I put my chips on the table. Then I set it in, and kind of reassess at regular intervals. So that's what I would say would be the biggest difference between the two.
Okay, and you mentioned something here about rebalancing your portfolio, which we're going to come back to when we talk about managing your investments over time. So, okay, I think now that it's clear what we're talking about, I just want to get a sense of what's your general investment philosophy from both of you for this one, or what's your general philosophy on using public markets investing as a tool for creating generational wealth, and at the same time, at what stage of your generational wealth journey should one start investing in the stock market? So I'm going to start with Brian for this one.
All right. I think my investment philosophy, to sum it up, I would say that when I think of investing, just like you were explaining there is, I think, part of it, which is whether you are a conservative investor or whether you are an enterprising investor. If you're someone who is a conservative investor, you're taking the long-term view, you're looking at to say what will happen in the long term. And so you're trying to figure out really what are the long-term trends. Is it going to be silicon? Is it going to be semiconductors that are going to be important? And so in my case, what I try to do is that I try to take a conservative approach, which is very much steadied, try to look at what history has provided, try to look at which sectors I think are important. And that is very much not an enterprising approach where you're trying to guess the market, what will happen next year, or even maybe in 3 years. I try to take a very long-term view of the market. And so, as I say, conservative. And then how I do this, I think there's a concept which I think maybe we might talk about later, which is called dollar cost averaging. Because it is very difficult, or at least because I think it is very difficult to time the market. That is, most people might say, I want to get in when the market is low. That is, I want to get in when stocks are cheap and get out when they're high up there, so that you can make money. But because I think it's very difficult to time those movements of the markets, what I try to do is a concept called dollar cost averaging, where, for example, at the first of every month, I just put in $100. I don't press to saying the market is up, whether it's saying it's down. Over time, I think, and also I have evidence, probably better off using this consistent. And then at what stage of sort of your generational wealth journey should you start in the market? I think it should actually be one of the first things that you set up. The reason why I say this is, of course, because in my view, it's a long-term thing to do. You don't want to invest in the market if you want to take out your money in 2 weeks, or even in 2 years. It might be too early to take it out, depending on how long the economic cycle is going to take. But I think what's important is that in the long run, companies will grow, they will make more profits, and in fact, your investments will grow. So I think starting it at the beginning of your generational wealth journey is important. The other reason why it's also important to start it at the beginning of your generational wealth journey is because it actually doesn't require a lot of money to start. Many people think you need billions or millions of dollars to get into the stock market, but it's not. In most stock markets, especially those that I interact daily with on the African continent, because they are really trying to have financial inclusion. Even if you have 100 Zimbabwean dollars, you can buy whatever shares that you want to buy on the Zimbabwe Stock Exchange, because they are really opening up the markets. And it's also, it becomes a little money you have and you put it in your portfolio, because if you try to wait for that day when you have $1 million Zimbabwean dollars, that day might never come, because emergencies always come up. But it's better to put whatever little that you have every month into the market. So that's sort of how I would look at what stage you should get into the market at.
Thanks, Brian. So I keep hearing the piece around long-term, start now, and Tap, as when you give us your response, there's a question that came into the chat around how are we defining long-term versus short-term in terms of actual years, months, just to give people a sense. So as you talk about your general investment philosophy, and when you think people should start investing in the stock market as part of their generational wealth journey, if you can touch upon that as well, that would be great.
Yeah, sure. So maybe let me just start with the investment philosophy part of it. For me personally, I like to think about, I think about the money that I'm putting aside, right? To Brian's point, I think the pot of money that you're going to put in the stock market, and this is kind of keying off of, the differentiation between trading and investing, right? If you're investing, I think you need to come to a point where you make a decision that, this pot of money, I'm okay putting it aside, right? And I'm not going to need to dip into it for quite some time, right? And I think you need to make a pretty fair, and honest assessment on your income and expenses. So essentially, what I'm saying, you need the budget to know, what's coming in, what's going out, and any withdrawals that you're going to need along the way, any big ticket items that you need to make. Then from that analysis, you have a pot of money that you say, okay, I think I'm ready to put this pot of money aside and invest it. And from a timing when you should start, I think you should start yesterday. So which means, go. But you need to be smart about that, right? So from a philosophy standpoint, for me, I started in a part of the industry where I've always been taught, entry points matter. So what do I mean by entry points? Because ultimately we all want to make money, right? That's not to say that I have a crystal ball into the market. I don't, right? Because otherwise, if I did, I'll be a billionaire. So I don't, right? And to Brian's point, you can't time markets. It's absolutely impossible, which I think it's very, very smart to do, the dollar cost averaging that he was talking about, to have, a little bit that you put on schedule and you invest into the market over time, because sometimes you're going to get great execution. Sometimes you're going to have terrible execution. That's just life, right? But what it comes back to is you want to think about what you're trying to achieve, right? So from an investment, horizon standpoint, when I say long-term, quite frankly, I'm talking about even 15, 20 years out, right? And that's not to say, set it and forget about it, right? Because we'll come back to the conversation about rebalancing and looking at your allocations. So when I think about, my investment philosophy, I really kind of like to look at companies that, number one, I understand, right? So I invest at an individual security level. We're going to talk about, different investment vehicles, right? Whether we're talking ETFs, mutual funds, and the different considerations, et cetera. So I want to understand the company that I'm investing in, right? Just understanding the fundamentals, not just looking at the financials and the historicals, but also thinking about the drivers that are going to drive future performance for those different companies, right? And I marry that with some type of a valuation framework. This doesn't have to be scientific, right? This doesn't have to be scientific. People get paid a lot of money to do this on a daily basis. But I think about, what kind of company I'm buying, right? To Brian's point about, semiconductors, I call that, a little bit of a thematic overlay, right? Thinking about what are some of the trends that, this company or this companies or this industry is going to stand to benefit over, the next, couple of years, right? And, there's no preset definition of short-term or long-term. It could mean different things to different people, right? But when I think about time horizon, the question that I always want to ask people is, if you put aside a pot of money, call it $1,000, $10,000, pick a number, and the market goes down 25, 30%, right? Are you able to look at it and go, it's fine, it might come back, right? I'm gonna wait it out. I might add a little bit more. Or are you the kind of person who is like pulling their hair out and freaking out and going, get me out of the market, right? So answer that question honestly as you think about, your time horizon. So for me, when I'm thinking time horizon, long-term versus short-term, long-term for me is I'm talking 50, 20 years out. But that does not mean I'm not going to do something along the way. And doing something along the way could come in the form of, maybe this has run too much. I need to reduce my allocation just from a concentration and risk management standpoint. Or maybe this stock or investment has been bitten down too much. I don't see any change in the fundamentals. I have high conviction in this idea. I'm actually going to double down, right? So that's how I think about things philosophically. And you don't necessarily need to be one thing in a portfolio. You can really break apart your portfolio where you say, okay, maybe 80% of the portfolio is going to be this quote unquote long-term oriented, and maybe this 20-25% is probably going to be what I call my play money, where I try to be a little bit opportunistic. It all comes down to your risk tolerance, right? You need to be very honest with yourself from a risk tolerance standpoint. Like, if I put 10 grand and I lose 10 grand, can I live with myself? Or am I just going to be super, super regretful, right? And you just need to answer that question, very honestly. So I hope that helps to answer the question.
Yes, it does. And you've touched on a lot of points here that we're going to come back to that are really important. And I guess one of the things I heard here, I think both of you are saying you need to start investing yesterday. So really, why? Maybe just let's talk about what do the returns look like? Give us some, investing in stock markets versus other, asset classes. Why the stock market? And Brian, could you give us the Africa context? Because I think you've dipped your hands in a few things, and I know Tafuma has as well. But Brian, why don't you start with the Africa context, and then Tap, you can give us the US or context as well.
All right. I will give the Africa context, but I will say from the beginning that unfortunately I did not prepare the numbers. The numbers are there for other people who might want to go and look them at. And also there's just the fact that some of the people on this call might not be able to invest in anywhere else other than the African markets. So we'll talk about it. So I think depending on how you look at it, there are companies that have really, returned a lot of money for their investors. In terms of there is a post that I put out last year. I'm trying to see if I can find it. But there is a post that I put out last year, and we can always share it after this, which shows sort of the returns that African markets returned in the whole year. Quite a few of them were in the green, of course, because of the pandemic. There was Zimbabwe, I think, and there was Nigeria, and I think South Africa. But most of the markets were in the red. That's not particularly a bad thing. In fact, when I saw that, I celebrated. And the reason why I celebrated is, as you have heard earlier in this call, sometimes you might have a conviction on different parts of the world or in different types of companies and markets. And when they go down, if you actually have money that's saved, it could be the best time for you to get some good entry point.
Go ahead.
All right.
Sorry.
So, okay, no worries. So it was actually an interesting time because other than keeping all my money invested, I do have some of my money in another account, which is sort of my opportunistic account. I do not have a play money account because I did not grow up with a lot of money and I don't like playing with money. But I do have an opportunistic account, which is when I feel really convicted that the world is about to shut down and everyone is not investing, which happened last year. Those opportunities do not come often. Those are once in 10 or 20 year timeframes that I was like, can I borrow more money to get into the market? Because I was very optimistic and everyone was pessimistic. But the thing is that I think human beings are just incredible. And I don't think there are going to be a lot of things that will come to us that we won't be able to solve. But when things like that happen, when things like pandemics happen, everyone freaks out. People withdraw their money. The stock market starts going wild. But that could be the best time to get in. And that was the best time for me to get in African markets and also in the US markets. So to talk about this, to give a context, I think it's hard for me to use a Zimbabwean context, given that there's a sort of a dislocation in Zimbabwe. Regular, observers of Zimbabwe will know that for a long time we have oscillated with different currencies, and so we don't really have graphs that show us, what has happened with companies over time, like over the long-term horizon. But I'm going to try to turn my camera around here and just show you a graph that I have here. This is Econet Wireless Zimbabwe. I get these trading updates from them. As you can see from this graph here, around April 22, this company was around 1,896. This is in Zimbabwean dollars. Depending on what rate you use, you can convert. But as you can see, up to July 29, this stock is almost approaching 3,000, which is going up from 2,000 to 3,000. Of course, this is really in a very short-term horizon. But then, of course, if I did have the charts, I would show you that people, if we average this out, you would see that most of the companies that we talk about when we talk of investing, they have actually gone up on a long-term horizon. I'm just trying to pull up one of my favorite examples, which I usually refer to when people ask about investing in the stock market again. I'll turn around my camera And this graph you're seeing here, this company is something you might be familiar with. This is Microsoft Corporation, which is something that manufactures Windows operating system that most of us have used. If you bought Microsoft when it was listed on 14 March 1986, it would have cost you 10 US cents to buy it. If you were going to sell it today after holding it to what TAP here defined as the long term, what I really also think is the long term, you would be selling this stock at $284.91 per share. I'll let those who studied mathematics in college determine what percentage it is in terms of these returns. But as you can see, if you're looking at these graphs of these returns, in the short term, it might not look like you make money. But then when you buy something and you're really convicted that this is something that's a long-term play, you really think that mobile money or telephones is what will change Africa, and you really think Econet is the way to go in terms of the Zimbabwean landscape, or you really think Safaricom is what you want to buy if you're in China, in Kenya, or if you really want to buy MTN if you're in South Africa, if you're convicted about something, I think in the long term, if you search around the graphs, you will see that the returns have been very interesting, not even dependent on what country or what sector you're looking at.
Okay, great. Brian, thanks for that. So I think we have a general sense now of like the what, the why, and the when. So let's move on to the how. And I do see the questions that are coming into the chat. We're going to address some of those as we go along. And so on the how, Brian, I'm going to come back to you again, because I think what I've personally struggled with, the first question, so just as some context for the audience, the first question that Brian asked me today was, what's my best stock in my portfolio? And I was numb because I was like, I don't know. And it's really shocking, I think probably for a lot of people, that I would say I don't know to that question. But, and I do need to work on that. But I think and part of my reasoning was because I use an advisor for my portfolio, but it doesn't mean I should be ignorant about what's in my portfolio. So anyway, Brian, in speaking about the how, can you talk about, because I think people come from different spheres, right? Where some people are really into the market and they want to be managing their own stocks. Then there's, if you want to use a financial advisor, and then there's something sort of in between. So can you talk about the differences of how you can incorporate that into their own strategy?
All right, I think I'll talk about 3 ways to go about this. There is, of course, you investing, which is self. You can use a robo-advisor, which is something that incorporates highly, technical stuff and algorithms and everything. But you can also use a personal financial advisor if you don't trust an algorithm. I'll talk about all these 3. Starting with the self, I think this is what we have been talking about ever since this course started. This is where you determine, according to me, your philosophy. And I think there are broadly 2 types of philosophies that you can go about if yourself, as a person, if you are going to take it upon yourself to invest. You can either be a conservative investor, something that I mentioned that I think I try to follow, or you can try to be an enterprising investor. An enterprising investor in this case would be someone who is really hands-on in their portfolio. This is someone who follows the news every day. So it's more like trading. An enterprising investor is very close to trading. You might wait out for a long time, but when this is not a dollar cost averaging approach. You're trying to figure out whether what you believe, in fact, you're trying to figure out when you think the market is wrong. And that takes a lot of guts to do, because most times when you argue with the market, you might sometimes lose, especially given how there is now big influence of robo-advisors, which is what I'm now moving into. So the robo-advisors are essentially sort of these systems that have been created by the big banks and many of the investment advisors that try to automate some of this stuff. The reason why you automate it, of course, is because you're trying to cut down on the cost. If you are going to invest, if you're going to advise Rungano here, who is a millionaire, on how to invest, you can certainly take one of the people on your staff to go and sit down in a nice office and serve a drink and then talk about her investment goals, because she is a millionaire. I hope you are. But if you are going to advise Brian, who just has $1,000 you really cannot dedicate your stuff to Brian, but Brian really wants to invest, with your firm. So what do? You simply create an algorithmic system that Brian enters all the things that he wants. How risky does he want his investments to be? Does he want tobacco companies or cigarette companies, sustainability stuff? A lot of things that you might want to ask. And then you automate these decisions such that an algorithm will be sort of investing based on Brian's philosophy or preferred philosophy of investing. So that's sort of the robo-advisor stuff. And then the last sort of way to look at this is the personal financial advisor, which I sort of touched on when I was talking about Rungano, which is where you look at the fact that some people are maybe like old around and looking at, them. They want to understand the market. They want to talk to a professional who is nicely dressed and can listen to their thoughts and everything else that they want, and whether they want to change their philosophy of investing or not. And for that, you're looking at a personal financial advisor. And the most important thing in that aspect really is to look at the fees, because most of the people that operate in this space of advising people in wealth management, that is sort of what the segment of the business is called. Most of these people are professionals. They know what they do, but then most people might actually lose more money in fees when dealing with these advisors than they would if they try to do it either on their own or either by using robo-advisors who, as you have already guessed when I was talking about them, would be cheaper than meeting a real human being. So probably this is what sums up sort of like the three ways of looking at this.
Thank you, Brian. And I am certainly a robo-advisor. And I think for the audience, I'll be curious actually to know if people are willing to share in the chat. Just type in, if you manage your own investments personally, you're doing it yourself, are you using a robo-advisor? I use Ellevest myself. I think there's Betterment. In the US, there's a few of them. And then, or are you using a personal financial advisor? So please share with us in the chat. And the reason personally why I use the robo-advisor is because I shouldn't say this out loud, but I'm not one who's going to be checking on a daily basis what the market is doing. And it's, the platform that I use allows me to invest based on my goals and my preferences. So for example, I have goals around something that I need to buy in like 10 years time, or if it's just generally creating wealth for the long term, or if I say want to buy an investment property in 5 years, then they come up with investment allocations for you based on your goals that you mentioned to them. Tap, can we then go into these different types of investments in the stock market, right? I've heard mutual funds. I still can't tell the difference. Index, mutual funds, ETFs, there's the actual stocks, bonds. So maybe a short differentiation of what's those and what are the considerations. What people on the call should consider as they decide whether to invest directly into a stock versus an ETF versus a bond. I know it's a loaded question. So
there's a lot to unpack there. Let me see if I can do justice there. But
when there's crypto, sorry.
Right.
Crypto, which came up as a question in here. Equity and bonds, I think that delineation is pretty is fairly straightforward, right. I hope, but just really quickly, with bonds, it's much more fixed income in nature, right? Where you have a security that's going to throw a fixed income stream of fixed income over a time horizon. That could be 7-year term, 10-year term, etc. Right, then you might have some fluctuation in the bond price, but if you're investing in fixed income, that's a much more conservative risk profile where you're just looking for income. With equities, you can have equities that also throw a dividend akin to a fixed income
instrument. So that could be, another way of proxying, fixed income investment with equities, particularly at a point where if the equity is yielding higher than fixed income, which happens to be the case right now with 10-year rates at sub 1-3%. But for the most part, if you're investing in equities, what you're really trying to play for there is really what I call capital appreciation. So maybe digging a little bit deeper into equities, I'll just call out maybe the three biggest vehicles that you can use for investing in equities. There's individual securities, like what Brian was talking about, where you're going and buying the underlying individual company, whether that's a Microsoft or an Econet, right? And there's different risks and consideration to that. But let me just talk about the other two. Then the other two being mutual funds and ETFs, right? Which tend to be somewhat similar, with the biggest difference being that ETFs tends to be a lot more traded on a public exchange. Right, and there's different fee considerations, with ETFs being lower in fees compared to mutual funds. But ETFs and mutual funds are basically pooled investments that pull a variety of individual securities into one investment vehicle. So, for example, if you buy, a sector ETF, right, say like a consumer discretionary, sector ETF, right, it's going to have, exposure to names like Amazon in there. And there's different flavors of ETFs, where some could be market cap weighted, some could be equal weighted. So to Brian's point earlier about going with advisors, sometimes they'll sell you a bunch of different investment vehicles, whether they're mutual funds or ETFs, that pretend to be one thing, but when you actually unpack them, they all look just about the same. Essentially, what they're trying to do is generate a fee by selling you the vehicles. So the biggest consideration there is really a couple of things. One is the cost and the fees, right? I think mutual funds tend to be a lot more fee and cost heavy, right, than compared to ETFs. ETFs, a lot of people use either iShares, Vanguard. Vanguard, I think they tend to be on the lower end of fees, almost next to nothing, right? So, if you're somebody who just basically says, and this comes to the question of, when you're investing and how you invest, you need to figure out, when you're thinking about the different ways of investing, self-directed, robo, and personal advisor, you just need to answer the question in an honest way, like, how hands-on or hands-off do you want to be? Right. And from there you can figure out whether you want to invest in, you want to spend the time to do the homework and the due diligence on the underlying companies, or you're simply going to say, I'm not smarter than the market, right? I just want a market return, where I'm just going to say, maybe I'll put my money into, the Vanguard S&P 500, for example, right? And that's probably next to nothing in terms of fees. And there, what you're essentially getting is is market exposure, right? If you go back to the question about how well the market's done, not to say that past is prologue, right? But if you go back like 40 years, I think the markets, have averaged like, 10%, compounded annual growth rate. And what you're really playing for then, answering the question of why invest now, is you want to use, the power of compounding to your advantage, right? I'm sure all of us understand what that is, right? You want to use that to your advantage. So there's that where you just say, all right, I'm just gonna, and that 10%, that's not to say that, it's going to 10% every year. We've seen a ton of volatility, right? Intra years, with last year being a perfect example, right? Where the market went down and March went down 30%, right? But it ended up like, 18%, right? For the calendar year. Right. So as you think about investing, you want to answer the question, like, how hands-on or hands-off do you want to be, right? And as you start thinking about, how do I invest, between just the individual securities, I am biased because that's where I cut my teeth, right? Instead looking at individual securities. And I think I'm knowledgeable enough. I'm not smarter enough, but I just feel much more comfortable looking at a company, understanding the fundamentals, right? Knowing what I'm playing for at the individual security level, right? And I know how to diversify my own portfolio. The other benefit of the pooled vehicles is that it already gives you that diversification, especially if you have, a very low minimum account that you're starting with, right? Because you can imagine trying to build a portfolio of, 40 to 50 stocks with $1,000, right? And if you wanted to include Amazon in there, you can't even buy a full share. You're probably just going to buy a fractional share, right? So with an ETF, it gives you that ability to just diversify at the individual security level. And sometimes it's a good way, especially if you just don't, we all have our lives where we're doing much more exciting things than paying attention to the market on a day-to-day basis. Trust me, you're going to end up pulling your hair out if you want to follow each tick move, right? So you just need to figure out whether you want to be a hands-on investor or you just, want to put your money aside and not have to worry about it. So that's how I think about, the different ways of investing and the different investment vehicles and the different considerations as well.
Thanks for that, Tap. And while we're on this topic, there's a question in the chat around, are robo-advisors available in Zimbabwe? I don't know if either of you know the answer to that question. If not, if anybody in the audience does know the answer to that question, please can you type it into the chat as well.
Well, there are certain vehicles that are sort of like investment clubs. I don't particularly think that we have automated robo-advisors. I think there are people like there are companies like Old Mutual that try to offer sort of investment schemes that get into the market, but they are not particularly defined. There's a contact of a guy who I have who is trying to get into sort of index funds, creating his own index funds. And of course, Old Mutual has also been trying to create their own index funds. So it's not really widespread in Zimbabwe, but there are people who are trying to work on that. And I can always try to drop resources later on that.
Okay, thanks for that, Brian. And I think as well, I know we do have some folks in the audience who are based in South Africa. If you do know about South Africa, because I'm also actually curious. I work for South African, you should probably know this, but if there is as well in South Africa, I'd be curious to know that as well. So I think Tap, you pretty much told us where, because I was gonna ask you guys, what's your, do you personally use a robo-advisor, a personal financial advisor, or you invest yourself? I think Tap, you've just told us. And Brian, I assume you're also using yourself. Do you use an advisor? I don't think so.
I do not. It's not because I think I'm smarter than everyone. I just think that I'm at a stage where I invest by myself, and in cases where I'm not sure about, that's where I tend to. I do have some of my portfolio in ETFs and mutual funds, just because I still do believe that going for the broader market can actually also yield returns, especially if you don't want to figure out what the themes are and what everything is. Yeah.
Okay, that's great. Okay, so we spoke about Tap, we touched on some of the fees because that is a consideration. Then the other place where I think a lot of us get stuck, myself included, is then, okay, so now I've decided I want to start investing $100, $50, $10 every month into the stock market. I have decided that maybe for me, I am going to use, let's call it a robo-advisor. Now the question is, which brokerage company should I use? Like, where do I open my accounts to do this? Because then now I have to decide between Fidelity, Schwab, or if I'm in Zimbabwe or South Africa, it's like I think it's Coronation is one of them in South Africa. There's multiple companies out there that are offering accounts for one to invest. What's the 2-3 main things that one should consider in picking who they open their account with? Brian?
Okay.
Why don't you
All
start
right,
with the Zim Africa context, and then we'll go to TAP for the US context.
All right. So in the Africa context, it's weird. I do have a series of videos that I talk about opening accounts on the African continent. And when I get to that point of opening an account, I usually say that the first thing you want to do, especially in the African context, is that you want to email all the advisors or all the stockbrokers. The reason for this is because sadly, which is weird because these guys are actually in the business of making people open accounts so that they get fees. Some African stockbrokers will just not respond to you. So if in Zimbabwe there are 23 stockbrokers and you write an email to the 23 of them, you might get 7 responding to you and telling you what you need to open an account. So if you are in Africa, before you even get to choose, just email all of them, except in Nigeria, because I think in Nigeria there are about 378 stockbrokers. So unless you have an algorithm to automate all the emails, which my friend Eric Kumalo of Emswini Code promised to get me one before I opened my account in Nigeria. He said he would automate it for me and everything will be done. But in most other African markets, you have about around 10 to 20 brokers, and you can really email all of them. After I email them, and in the event that they respond, all of them, I do what I call the website test. Well, this might sound dumb, but I usually do actually think that stockbrokers in Africa who put effort to really create a really good web page where they have all the information that I need there before I ask them, where they pull out their research, even though maybe you might need to subscribe, but most of them you don't need to subscribe, where they post their regular research and their views about the stocks there. I think those are serious brokers and you need to take them seriously. And then after that, of course, after I think maybe if I have 5 brokers who have responded and all their websites I think are good, then I write to them and I say, look, I need to know about your fees and I need to know about your research. I'm someone who is very interested in figuring out what the players in the market think. You might not know this, but in most African markets, the themes are really different with what you would find in outside markets like in the US. So for example, the research that I get from my broker in Zimbabwe, my broker is Lighton Edwards, but I also read my broker is Lighton Edwards, but I also read research that I get from other brokers. It's very interesting how brokers look at the markets and how I look at the markets. So brokers will tell you, for example, that look, it's October, the government has released money for command agriculture, and we think this is what's going to be there for the market. If you're someone who is an outside player, and if you're someone who has been in the diaspora for 7 years, you might not think that there's a correlation between the government releasing money for command agriculture or giving farmers free inputs and what the market will do. But surprisingly, there is. There is a big correlation when the government releases funds. There is a very interesting, way in which the market reacts in Zimbabwe when tobacco farmers get paid, even though tobacco farmers don't really invest on the market. But some of these things are something that you really need from the brokers who are operating in the ground. And so, for example, you'd imagine when I open an account in Malawi, I would really need a serious broker who can give me research so that I can understand that market. So research is important if you're in the African context. Websites, not so. But then, of course, the last point, which is important, is the fees. I think, fortunately for the African markets, it's usually the case that the fees are actually regulated. So, for example, in Zimbabwe, the Zimbabwe Stock Exchange has already legislated what fees brokers get. They don't get to decide what they want. So it's usually, I'm forgetting the percentage, but it's probably 0.125% of whenever you do the transaction, when you buy or when you sell, and there's a broker fee that's there. So unless you want to pay for extra things like extra research or extra advising, when you're talking about fees, I think the good stuff about the African context is that most of the stock exchanges or the Securities and Exchange Commissions in a different country usually legislate the fees. So you might find a standardization on that. But then, of course, you really want to ask all the brokers, what are the true fees that I'm going to pay when I buy, and what are the true fees that I'm going to pay when I sell? So I'll let Tab talk about sort of the US context for that.
Thank you, Brian. And while Tab is talking about the US context, Brian, can you please in the chat just type in some of the 5 brokers that you know in Africa that people can at least look into, that you have used, just to start to put some resources out there where people can start digging for information. Tap
Sure,
over to you.
I'll put in the brokers that I use.
Thank you.
All right,
Tap
so
over to you.
all right, thanks. So from the U.S. perspective, it's not as it's not as onerous and complicated and twisted and convoluted as it sounded for outside of the U.S. Quite honestly, in the U.S., I think with all the brokers, what you've essentially seen is a race to the bottom in terms of fees, trading fees and commissions, right? So whether you're looking across a Schwab platform, an E-Trade platform, an Ameritrade platform, or an E-Trade platform, they are pretty much close to a point where it really costs you nothing to buy and sell. That does not mean that they're not charging you something, right? Because there is always a little bit something in the bid ask when they do an execution for you, where based on, whatever market participant they are pushing your trade or your volumes to, there's some little bit of, rebates and give back where they might, pinch a little bit. So, the good thing about the US is that it comes down to competition, and a lot of the brokerages now are trying to move to a point where they will actually be pretty transparent and give you a comparison of what execution means on their platform compared to their competitors, where you actually can tell, oh, Fidelity gets me better execution than Schwab. So the first thing I would say is, when you're doing your homework and your research, right, look at who gives you the utmost transparency, right? Because in the US market, there's absolutely nothing to hide, right? Because I know Fidelity, does a better job of providing that level of disclosure. In no way am I marketing Fidelity here, but they do a better job of providing that disclosure. I know Schwab does that too, right? And as you're starting to think about which broker to go with, I'm not so sure if minimum amount is that much of a big deal at this point where they require you to have minimum amount. I don't think so, right? So you can essentially go with just about any broker. And I think all of them at this point have moved to fractional trading, right? Where that's, if you don't have, say, the $3,000, $4,000 to buy one share of Amazon, you can essentially buy a fractional share of Amazon worth $100 or $150, right? So, I know Robinhood is in vogue right now. That's not the only game in town. It's much more popular with the millennials, etc. They gamify things a little bit here and there. But whichever broker and platform that you go with from a fee standpoint in the US, I'm not really sure you are going to be shortchanged by one versus the other, right? You might just want to look at things like, with whichever broker you go with, do they give me access to certain kind of research? And what I mean by that is, E-Trade just got bought out by Morgan Stanley, right? So now if you're an E-Trade customer, you're getting Morgan Stanley research from Morgan Stanley analysts, right? Which is, a big investment bank on Wall Street, and, one of, the good investment banks that produce quality research. As you just think about the content and depth of research that you can get on individual companies, that's assuming if you want to do individual security investing, right? If you go on a Fidelity or a Schwab, you might not have access to Morgan Stanley research because you have to pay for it. But because you're an E-Trade customer, you just get that research for free. So those are some of the things that you need to consider.
Thank you, Tap, for that. I think the research one is a big one, and having access to research, as are the other points that you mentioned. So what do you use you don't mind me asking.
Yeah, sure. So I use Fidelity, and I used to use E-Trade, and I switched to Fidelity just because I wanted to consolidate everything with all my other retirement accounts, right? So, that could be another consideration. Say if you have an employer, that's already using another provider for your retirement accounts, and if you just want to consolidate everything onto one platform, that's also a potential consideration. But if you go with any one of the ones that I mentioned, I think you're going to get a similar kind of experience. And the other thing too that I forgot, that I neglected to mention, is that in the US, the other consideration you might want to think about is, does this broker allow me to buy international equities, right? Because some don't have that level of capability. And one of the reasons why I switched to Fidelity was the international trading capability, right? Some providers are not there yet. So, that's where the fee consideration is probably more important when you're thinking about fees, and if you want to trade like international equities. So, another additional consideration there.
And a follow on to that, is there any risk in consolidating all of your portfolio with one broker?
I don't think there is any risk of consolidating your portfolio with one broker. It's for me, it's the convenience of having everything under one platform, right? And when you're thinking about your financial position, you have the entire picture, right, in one place. And when you're thinking about your allocation, you can think about your allocations holistically, right? You think about it as essentially the same pool of money. And when you're splitting up the allocations, you're doing the allocation not on a sub-account level, but you're doing the allocation on the overall financial picture. So for me, it was just a choice of being in one platform where I can easily manage. And quite frankly, you probably start to get the benefit of the platform where they try to give you a little bit more resources if your account then grows bigger as you consolidate, right? Because you're bringing more business to them, right? They try to throw more services that can be helpful to your investment process.
Okay, thank you. That's very helpful. Okay, so we can pick a broker now where we're going to open an account. I have the account. This is where I now was getting analysis paralysis. Hence, I was like, somebody has to do this for me. So how do I choose whether it's going to be Microsoft or Tesla, or if it's MTN or Econet, or if it's an ETF, like VU, or, there are different ETFs out there. Like what are the top 3 things, let's say, that one should do in making that decision of going into a Tesla versus a Microsoft, or an MTN versus Safaricom, or like a specific ETF, VU versus, I don't know what Fidelity has.
Yep. Sure, I can start with that. So I would say the first thing is, do you want to be hands-on or hands-off, right? Number one. And number 2 is, how big of, an amount are you starting with, right? And when I think about investing, philosophically for me, I always want to know and understand what I'm investing in, right? And do I know what this company does, right? There's a lot of fear of missing out trades, which I don't really subscribe to, right? Whether you're thinking that's GameStop or AMC, and I'm not saying you're not going to make money in that. You absolutely can make a ton of money. You absolutely can get your face ripped off too. But for me, I really want to understand, what the company does, right? I spend a little bit of time looking at the financials just historically to see, how this company has performed, as well as how does the company make money, right? And from there, you know, I want to get a sense of, you know, the industry and the competition, and, you know, can this company continue to make money, right? So that's the fundamental picture of just understanding the company, what it does. Does it make money? How does it make money? Or is it going to make money? Is it in a very attractive industry that's going to grow? You know, is this growth going to be, you know, sustainable? Do I think this growth, you know, can be around for a couple of years? Then, you know, number two, this is probably brain damage just because, you know, this is what I do, right? But I also want to understand if I'm going to think about valuation, right? The same way that if I go into a store and, you know, I know, you know, a loaf of bread, say, costs $1, but today it's, you know, I'm being charged $3 or $5. Why, right? So I really want to understand, like, you know, what's the cost of, you know, the investment? What's the price that I am paying for it? And if the price that I'm paying for it is, you know, say $10 and it's traded at, you know, a lower level before, why? So I want to understand what's the metric upon which the price is being determined. So essentially what I'm saying is valuation, right? What's the valuation for this company? So I want to get a sense of, is it expensive? Is it not expensive? Is it a good time to buy? Will I have an opportunity to buy it? Or maybe can I leg in a little bit if I wanted to buy $100, you know, dollars worth of it? Maybe should I just put $20 and say maybe I'll come back and look again if it's gone down and I think nothing has changed, I'll buy a little bit more? Or if I don't want to play, you know, that, and I just don't have the bandwidth and capacity to do that level of due diligence, I simply say, you know, I'm going to put my money into the market, right? Because I just don't have the time to, you know, to be doing the homework to look at individual companies, but I want to get some exposure, and I don't know whether things are going to go up or down, but I just want to have some exposure to the market. I say, okay, fine. What I'll do is I have $1,000. I'm not going to put $1,000 now because I don't know if this is good execution at these levels, but I'll just say, you know, I'll use the time as my friend here, and I can try to sort of like do, you know, drip over time, i.e. dollar cost averaging that, you know, Brian talked about at the outset, and just say maybe every month, right, I'll put $10, right, and regardless of wherever, you know, the levels are, I can also do that and just buy, you know, either that's an ETF or mutual fund index ETF or whatever, right? And that way I'm basically saying I want to get some exposure. You know, I don't know what the level is, but I don't feel comfortable putting everything up front. But at the same time, I'm not going to spend time because I have so many other exciting things to do. I'm just going to dollar cost average over time. So that's how I would, you know, start off thinking about, you know, whether I invest in an ETF or an individual security. Pretty frankly, it can be overkill to do the analysis that I talked about initially. But at the end of the day, I always tell people, you know, just make sure whatever you invest in, you know, something about that company. And that something has to be what the company does, why you think the company is going to do well, right? Don't just, you know, make blind investments and just hope that it's going to go up because everybody is talking about it, right? If you care enough, spend a little bit of time. I'm not saying spend all your time, just spend a little bit of time, because, you know, it's you know, making money in the stock market is not easy, right? You could lose everything. So just spend a little bit of time, know what you're investing in, and you know, it's just know that, you know, you can't predict the markets. Nobody knows what's going to happen. But if you've made the commitment to put some exposure, there's smarter ways to do it.
Yeah, and I think I see a comment in here from Clara, which I think she raises a good point, that, and it's part of what you're talking about, Tap, which is for newbies, right? I think it comes down to, one, your risk tolerance. and how much time you're willing to spend and your ability actually to learn and understand this stuff as well, right? So for newbies, depending on all those other factors, I think the other piece is if you're somebody like myself, then focus on investing in the market. So look at the ETFs that offer you a little bit of more diversification, that rather than going into one individual stock. But also there's learning that comes from investing into, if you're that type of person that comes into, say you want to put 0. whatever % of your available income to learn how to invest in individual stocks. We're going to go into questions now, and there's a lot of questions that have come into the chat, so I'm just going to focus on the questions that have come into the chat. While we're on this, each of you quickly, what's been your best investment so far? Tap your green, so we'll start with you and then go to Brian.
What's been my best?
Not why or how, yeah, just what has been your best investment so far?
Oh gosh, wow, that's a good one. Over what time horizon, I guess, is the question.
Whatever comes to your mind first.
Sure. So best investment for me, really has been, I'd say, I bottom ticked some of the financials, Goldman Sachs, when we had the big sell-off in March of last year, to Brian's point earlier about, be greedy when everybody's fearful and be fearful when everybody's greedy. So that was my philosophy at that point. And that by no means does not mean that it's an absolutely great company that's going to continue to do well. And back to the point about, the pot of money that's long-term, a pot of money that's opportunistic. So that was more of an opportunistic trade.
Got it. Thank you. And Brian?
Well, it's weird to say this as someone who is a long-term player, but it's interesting that I actually made a substantial amount of money from Bitcoin. It wasn't really an investment. That was clearly speculation. But I did speculate at the right time, and I was in college. It was amazing. I think one of the people I listen to is is Warren Buffett, and he talks about how it's very interesting that you never see who is swimming naked until the tide goes out. I mean, it looks like the tide hasn't gone out, but clearly I've left the river, as I can say on this platform. But it was interesting as my best speculation. In terms of what I consider my best investment, it's actually a company that's very close and dear to my heart, founded by a guy who started his life in South Africa and Zambia. And this guy is called Elon Musk. The company is Tesla. It's actually interesting because it's something that came out of the pandemic in college, and we really had nothing to do. Myself and my two roommates, one who is Ethiopian and one who is Rwandese, and we were just thinking of all these. And this guy kept on saying, Tesla is really interesting. Tesla is interesting, and he would make so much money, and then he would get out. And then I said, well, I need to read up on this company. I mean, I generally understood what the company was doing. And what I did not understand really was why all these other automobile companies were not catching up. I could not understand why Ford or BMW could not quickly just make an electric car and take out Tesla. And it's only after I did a lot of research that I realized, they had some competitive advantages that they had, and they were building this moat around this industry, and they were having more data coming through and perfecting their cars faster than their competitors. It was interesting when I realized that. That's when I decided to get in. It's been an interesting long-term play, and I'm still holding on to it, though it did peak at some point and it went down. But I still think it's actually an interesting story that they have. It seems to me, until I really see something serious coming out of the other competitors in the automobile industry, I think it could be an interesting time to keep on holding to Tesla, especially given that it has actually been turning out pretty well in the past couple of months and years.
Okay, so we're really running out of time. So let's call this the Fryer drill of questions that's just going to be coming at you guys like that. Your views on cryptocurrency in 1 minute. Tap, I know that's a tough one.
Oh yeah, no. That's a great question. A quick one for me. None, really. I stick to stuff that I understand and know. So I'll leave that one to the experts.
And Brian, I know you invested
My
in
view.
crypto.
Well, I did, but I got out. We should tell people that I got out. Well, look, here's my view. I'm a student of politics. I think every time, in lots of history, parts of history, some people have tried to sort of threaten what we call the world order. I think central banks still retain a lot of power in terms of monetary policy, and I think cryptocurrencies have really tried to dabble into sort of misbalancing that power. And I think over time, I think something is going to be reined in. I don't think the political authorities in the world are going to let cryptocurrencies be what we think they are going to be. And so from a political perspective, I think they're going to be nipped at the bud at some point. China has already started cracking down on them. A lot of other countries have already started cracking on them. If you have them, I won't give you advice, but I can only tell you my experience. I had them and I got out. And so I don't know, if you want to stick in, and we can also always have this discussion 10 years later, what happened with them.
I think the jury's, I don't know, still out on that one. For people who are in Zimbabwe, can they invest in the US stock market?
I do not think so. That's just, I don't, there is no Zimbabwean broker who can give you exposure to US markets. I think if you are in South Africa, you can do it with the South African brokers, but not with the Zimbabwean broker. And even when you get to the US, it's very difficult to open a brokerage account with a Zimbabwean passport. It was difficult for me to do so. I don't know about TAP, but yeah, it was difficult for me to open one as a student in the US.
Okay. And somebody asked, T. Sibanda, can you re-explain dollar cost averaging? Dollar cost averaging. Quickly. I think TAP, you're the one who has started talking about it. So maybe just
maybe TAP works.
Yeah, sure. It's simply this, right? Say you have $1,000, right, that you want to invest. Instead of putting, the $1,000, investing the $1,000 up front, you're going to split that $1,000, over, into $100 investments over 10 months. And you just, pick a date and say, at the beginning or end or the middle of each month, you're just going to invest $100 over 10 months, right? Over 10 months. What you're essentially saying there is that I don't know what the price is going to do, right? But I don't want to take all the risk up front of putting the $1,000. What if I, invest, the $1,000 at $10 a share, then tomorrow it goes down to like $8 a share. You're like, oh, damn it, I should have waited tomorrow and invested a little bit. So you're essentially saying, I'm willing, to take, to give myself a little bit of, wiggle room and hope that, when I invest the next tranche, it might be lower than the $10 that I invested the first tranche. So essentially saying that hopefully when all the amount is fully invested, my execution all-in cost will probably be less than the $10 when I started investing the first tranche. Essentially, that's what dollar cost averaging is.
Yeah, and I think it's that concept of you don't want to be timing the market, especially if you're somebody like myself who is not following on a daily basis, right, of what's going into the market. And I don't remember what the stats are, but what I personally essentially do, and financial advisors advise you to do this as well, is I have a direct deposit from my bank account every month into my investment account for a certain amount of money that just goes in on the same date every month. It just goes in. I don't think about is the market high or up, but over time, I think the general view is that you are better off than trying to time the market.
Market time is extremely difficult.
It is. I did try to do that and was very, very not successful at all, which brings me to a question that is on everybody's mind, because I've been thinking of that as well. What's been your worst investment so far?
I'm going to defer to Brian on that one.
Brian? Or
Anyway.
if you can't talk about which one, it could be what was the mistake that you made, or your biggest lessons learned on your investing journey so far.
Yeah.
You can go ahead, Tam.
Okay, all right. Okay, let me take that one anyways. So for me, the biggest mistake was putting on a trade that was a little bit of, not a little bit, a whole lot of just getting in on a frenzy and not getting out in time, right? So back to my point in talking about stay away from stuff that's frothy, right? And the lesson for me there was stick to your knitting, right? Stick to what you know, right? And number two, the second lesson was don't get greedy, right? Sometimes when an investment runs too hot, have the discipline both on the upside and the downside, right? If you have levels where you say, if it goes below this level and it's signaling to me that something has changed fundamentally, I'm looking to reassess. On the upside, have the same discipline as well. Have target levels, right? Where you say, okay, if it's run this hot, I think I am comfortable taking chips off the table, because at the end of the day, right, nobody ever made losses taking profits, right? So always remember that, right? So have the discipline both on the up and the downside, right? So I made the mistake of, holding on to it so that it runs a little bit more. And to your point about timing the markets, I ended up, in the negative. And, those are situations where you always look at yourself and you go, oh, gee, done. Wasn't I stupid there?
Thank you. And Brian?
Well, I will say I think the biggest mistakes have not really been when I, sort of say that I did not sell, I did not buy. But I think that, in fact, I would say what I usually say is I knew that this was something that was certainly good, but for some reason, I just did believe that the market was not taking it seriously, and I read too much into the news. So, for example, I think talking of the Zimbabwean context, something that actually happened in the past couple of years is that Econet unbundled some of its business into something that was called Cassava Smartech Zimbabwe. I was already an Econet shareholder, so I naturally got shares in Cassava. But it was actually a very interesting business. A lot of people did not realize that there was a lot of value within one of the subsidiaries, which was EcoCash, which was parceled out into Cassava. And EcoCash maintains a very high market share in Zimbabwe in the 90s. In fact, there are some people who have argued that EcoCash is no longer a company, but it's a utility, just like electricity or water, and it should be considered a national security asset, given how much power they have in the market. And for some reason, I sat there, I sucked my thumb, and I should have loaded more on Cassava. But then, of course, over time, I have tried to increase my holdings within that position. So I think that that's sort of what I would say is my biggest mistake, which is I knew something was really good, but I sat there and I sucked my thumb, and I was really waiting to see if the market would agree with me that is something that's good. And then, of course, talking of what I think has been the biggest mistake that other people that I talk to who invest in African markets has been, is that people treat their financial accounts as if they're treating their checkings account. Literally, I've had people call me and say, look, Maro, this is the name that people who only know me from YouTube use. So they say, Maro, you see, we're approaching Christmas and I'm selling my stocks because I really need to buy groceries. And I'm like, no, this is not how you do it. I've been putting so much effort into making videos telling you guys you should do this for the long term. And you tell me you want to buy groceries for Christmas? Really? So I think that's one of the most important, or like one of the most frequent mistakes that people make. It's either they just think, you know what, I have money in the market, I'm going to sell and go and have a holiday, or they really hit a financial patch and then they just have no option but to sell. And to that, I say that I think if you really have such a situation, then you should try to have a separate savings account, is an emergency account, that only after you have exhausted the emergency account do you then have no option but to sell your investments. But if all your money is in your investments and you have no money for emergencies, then when an emergency comes up, you're going to sell. And usually it might not be the best time to sell, and you might end up sustaining losses because of that. So that's what I would say about mistakes.
And I think, you know, the timing of selling as well. There's a question here which we had around the tax implications of investing that you should consider. I guess really quickly, what's the number one thing around tax that we should all be aware of when it comes to investing in the stock market? Tax.
Yeah, sure. So for US-based investors, right, you're going to think about, you know, the tax on short-term gains versus long-term gains, right? Short-term gains are going to be taxed at your ordinary income tax level, which is way higher than the long-term gains. I think long-term gains is something like 15 or 20%, right? So long-term gains means, you know, you've held the position for at least a year, right? So that's another consideration. I don't think, you know, anybody loves paying taxes. They can be a pain, and, you know, they can really do, you know, quite a bit of damage if you're taking short-term gains there, right? And, you know, if you're going to be doing the short-term trading, you know, make sure you have enough money such that by the end of the day you actually have, you know, the money to pay the taxes, because you might try and do the short-term trading where you have, you know, a bunch of gains that you've accrued and you have taxes on them, but, you know, your positions are underwater and you can't pay the taxes, right? So just a consideration to have their long-term versus short-term gains.
Thank you. That's a really big consideration. I think, Brian, it's probably the same in most markets, right? But if there's a difference,
it's probably the same. But then, of course, people should know that in most markets, you will pay more money when you sell your stocks in taxes than when you buy them. Of course, that is in taxes and fees. So, for example, sort of the total amount of fees that you pay if you buy something on the Zimbabwe Stock Exchange, I just put something here, is 1.693%. That's the total you pay when you buy, 1.693% of your money. But when you sell, you have to pay 2.443% of your money. So that's in, you know, like broker's commission, VAT, CST levy, and a lot of other levies that you pay. So of course, when you sell, you get penalized more, which is actually a good thing if you look at it, because if you stay in the market, you will get all these long-term gains. And then of course, this tax will differ if you stay in for the long term instead of just short-term trading.
And Brian, while I'm with you, and again, really quickly, Aaron Much says he runs a secondary school and is wondering what are your views on teaching students in high school how to invest?
Interestingly, I think in the case of Zimbabwe, at least, the Zimbabwe Stock Exchange actually, I think, has programs which they either invite students to come in a bus and, you know, spend a day at the stock exchange and be taught, or I think sometimes they can even drive themselves to a school. So I do have a contact of someone who works at the Zimbabwe Stock Exchange, I think, who is their corporate communication manager. I'll try to see if it's there, but the contact is there on the Zimbabwe Stock Exchange website, or if you just tweet to them on Twitter and say, we want to organize a session for students, they actually do have sessions like that where they teach students about the basics of capital markets.
Wonderful.
I'm not particularly sure about other African markets on that.
Okay. Then your favorite books on investing?
All right, I can take that first. I think my all-time favorite book on investing is something that was written by a legendary investor who's called Benjamin Graham, his dad. I try to only trust books from dead people when it comes to investing. The Intelligent Investor is the name of the book. And then my second most favorite book is actually called The Little Book of Common Sense Investing. It's a very interesting book. It's actually a very small book. The title matches with the book. It's a little book and you can quickly read through it, but it gives you so much insight. The writer of this book, I think, is the founder of Vanguard, John C. Bogle. I don't know whether I'm saying his surname right, but I think he's the founder of Vanguard, and he's talking about, really using index funds as a way to build wealth, which is interesting. And then another sort of a book that I read recently, which is interesting, which is not just about investing in the stock markets, but about financial literacy in general, is something that was actually written by a fellow South African YouTuber who calls herself Financial Bunny on YouTube. Her real name is Nicolette Mashile. Mashile, and she recently wrote a book which was published last year, which is called What's Your Move? It's one of the most interesting books. And she talks about financials in, investing in stock markets, different vehicles for investing in the South African markets, what to do about dating and financing and financial stuff in dating. It's really an interesting book. So those are my favorite books.
Thank you. And Tap, your books or resources, if not books.
Yeah. I mean, on books, it's going to be, much of the same that Brian has talked about. I think, Benjamin Graham's Intelligent Investor is, quote unquote, the Bible. Then I'll add one up on Wall Street, Peter Lynch. That's a really good one, right? Just to, get your arms around the concept of, invest in stuff that you know and understand. In terms of resources, I mean, I think there's a ton of resources out there, right? I would, urge people to go to websites of, some of the biggest, asset managers, right? Whether that's a BlackRock, and, just go to their blogs or to their investment institute websites and see the bunch of research material that they post there, right? It not only helps you to kind of frame, the current market views, but it also points you to additional resources, right? In addition to things like, whether that's reading the Wall Street Journal, Barron's, Investopedia, etc. There's a ton of materials and resources that you can read out there.
Okay. And I'll just add to that list. I've mentioned this one before, Clever Girl Finance. I think it's similar to like the Nicole Mashile type book it talks, she writes about, she has a couple of books that are out actually. One is just around your personal finance journey, starting with savings, how much to allocate to investments, managing debt, all of that stuff. And then investing and relationships once you have kids, retirement, estate planning. So she has a couple of books that are out. If you just type it's Clever Girl Finance. She has a podcast. She's also on Instagram, and she has a couple of books that are out. And it's in a language that if you're not somebody who's in the market every day, you could understand some of the basics of how to do it. So I highly recommend that as well. I think I think we've covered all of the questions. I hope I did. But this has been a very, very heated up, insightful conversation. I really do appreciate you guys. And to the audience, thank you as well for your questions that kept coming in. And I think we had, some people also sharing their views on some of the topics that we discussed today, which is exactly what we want this to be. We want it to be as interactive as possible. So I do want to thank everybody. This was really great. If you have any further questions, you can connect with us through the Education Matters page on Facebook. This will be posted on the YouTube channel as well for Education Matters. Share your questions there. The next two topics after health and wellness and the fundraising campaign that we're going to be going through will be on estate planning and retirement. And then we're going to close the series towards the end of the year with bringing in some of what I call our elders, those who've, let's call it, made it, who've been on this path for a much, much longer time than any of us. I think most of us on this call are. But if you do have other topic suggestions for things you're interested around this topic, let us know, because we can always make things around. I think this is a very flexible community and it is about learning. So Tap and Brian, I can't thank you enough. This was a lot of fun. I think the first question that Brian asked me about what's my favorite investment was just a sign that as somebody who's focusing on this Generational Wealth series, I should probably know what's in my portfolio. So that is homework for me. Each person on this call, I hope, goes away with some homework that we all need to do. And you've invested this time. So it's the work that we do afterwards that also matters. So guys, thanks a lot. Thanks everybody, and enjoy the rest of your Saturday.
Pleasure. Take care.
Today.
Thank you. Are you closing the call yet?
No, I'm not going to close it. We can stay. We always like to stay. If you want to show your faces, those who want to say hi, we want to see your faces too. I could try and play Kumusha in the meantime.
You really love that song.
No, I had forgotten about it.